Welcome back. Banks are collapsing left and right. $1 million bets on Bitcoin. What do you need to know? Why is this happening? And what do you need to do to protect yourself? Let's dive in. You might have heard it. Banks are collapsing left and right. There are some clear cracks in the financial system. Here's what you need to know. Here's what you need to do. Let's dive in. So we haven't had a big incident since I think Wednesday, but next week is probably going to start off strong. So normally, normal people are probably slightly worried about this. I'm not at all, because I've been prepping for this moment for quite a while. If you have seen my other videos, you know exactly what I'm talking about. So banks are imploding, but no need to worry, because a large part of my portfolio is in Bitcoin. Short disclaimer, as usual, down below. So the last few days, we saw Silvergate, Signature, and Silicon Valley Bank completely imploding. What's happening? Why is that happening? It's actually not that complicated. You can really generalize it a little bit. Here is how all of that works. So 3 major banks in the United States, they're insolvent. Lots of other banks are actually insolvent as well. There's studies that show 186 banks in the United States suffer from similar issues, and it's not just a United States thing. This is a worldwide problem. We've seen Credit Suisse, we've seen issues with Deutsche Bank, and so on. So why is that? During COVID and the whole pandemic, we had these unusual low interest rates. And for banks, there was no place to hide. So what did they do with their money? They were taking deposits from people like you and me, from companies, and the money was laying around. And they were greedy and they were arrogant. So what did they do? They allocated this money into US Treasury bills, meaning government bonds. They thought this is risk-free return, but it's actually return-free risk, as we discussed previously. So they locked in their money for 5 years, and they were getting like 0.5%. Some were getting 1% out of it, locked in for 5 years. So now, within a year time, the Fed raised the interest rates, as many of you know, and we're approximately at 3.5% right now, meaning you're getting like 6 or 7 times more yield on the same product. And the locked-in product that all of these banks had and got massive exposure into that product, they're locked in. So this product is practically worthless. They're getting 60 cents out of $1. Of course, they can wait until the product matures. If it's at 5 years, they will get the initial entry plus the API that they agreed on a fixed term. But, and here comes the big but, they're not liquid. Meaning, in a case where we had Silicon Valley Bank, where there is a bank run and 1 out of 10 people wants to get their money back, they cannot deliver up on their money because it is locked in. And in that point of time, they practically need to liquidate a US bond that is locked in for 5 years. But nobody wants to buy that bond because they can get a better one. They can get one with 3.5% on it. Why should you buy the bond that is just yielding 0.5%? And this is where the problem is. So bad risk management, actually. They locked in their rates at a super low rate, and now they cannot get out of it. They don't have enough reserves. And this is all over the world. Europe's banks are suffering from this. US banks are suffering from this. And it's practically the same thing as SBF with FTX did. It's just an accounting trick. All of these banks, a large majority of banks, are absolutely insolvent. And as soon as this triggers, there's like a cascade effect when people actually want their money and go to the bank and take their money out. Just 1 out of 10 people, because normally a normal reserve rate is between 5 and 7%. So they only have like 5 to 7% of their actual depositors' money in cash, and everything else is not available. Some banks have even less than that. An industry average in the United States, like less than 10%, which is really, really bad. And you can really see the cracks forming in the system. So here we have the Fed fund rate increase in a percent measured rate. So, and this is the biggest increase they ever did since the 60s. And this is exactly why these cracks are forming. So the Fed caused that problem, and the bad risk management on the sides of the banks is causing a collapse. We don't have seen the collapse yet because they jumped in, but let's see what happens next week. This is just if you raise from an almost 0% rate to now 5 or 6% rate. This is what this looks like. So the largest percent increase since the 60s. Here you can see like as higher as these graphs spend, the more unrest, the more cracks in the systems are there. And you can really see in 2008 we had high spikes, in 2020 with the beginning of the pandemic, and now again. And here this is illustrated a little bit more. Fed discount window is what that is called. And look just what happened in the financial crisis 2008, and look what happened in 2020. So we're at the same point right now. Scary. And here as well, so the Fed has two ways of interacting with the market. They can lower and raise interest rates, which they are raising interest rate, but they have also the balance sheet where they can unwind and buy back. So quantitative easing can usually happen with those two general tools. And what they did, you can already see, we're going into easing again. So the balance sheet moved upwards, and they can do both at the same time. They can have high rates while unwinding the balance sheet. Like the last year, they did both. So they were selling off their balance sheet and increasing rates. Now they are holding rates. Next week, we have the next Fed meeting. But at the same time, they are selling, buying back, increasing their balance sheet. So what can you do to protect yourself? Pretty easy. So the first thing, I'm not a doom and gloomer. I don't believe in a complete system collapse. But what you want to do is, if there is a bank run, it doesn't really matter if you're in the United States or in Europe, you want to be prepared. How can you be prepared? Keep 30 days of spending for food and water and things like that, cash on hand. Because you don't want to be one of these people that are standing in line in front of a bank if there's an actual bank run. It doesn't cost you anything. Just probably for most of you, $1,000 is enough. Just keep $1,000 of your local spending currency in cash at home. Because within 13 days, 14 days, 30 days, the government is going to jump in. There will be solution, there will be bailouts or whatever, but you don't want to stand in line. So keep a little bit of money at side. So the other two things we talked about that extensively: gold and Bitcoin. It's pretty easy. Just look what happened when all of this unwinded in the last 2 weeks. Citigroup, JP Morgan, Bank of America, all were selling off drastically, Bitcoin picking up steam. Same for gold. Here, another one, Bank of America and Credit Suisse. You can really see Bitcoin outperforming. Look at this chart. Macro downtrend, we saw that, and here we perfectly bounced off that trend line, and we are now rising with an increase in banking concerns. It's a great setup for Bitcoin. Bitcoin was made for this. The only reason it was made for in 2008 is because of the financial crisis, the banking crisis back then. So some hopium at the end, and a few considerations for you. So this is Plan B stock to flow model. Usually you want to buy blue. I've been talking about buying and DCAing over the last 2 months. If you haven't done so yet, sorry, what are you waiting for? You should be fully allocated now. Here you can see the long-term price charts from 2012 until 2023, and 3 times or 4 times actually we saw that reversal, once indicated here in 2012, once in 15, once in 18, and now in 2023. And this time it's not going to be different. Bitcoin is set, and both gold and Bitcoin are set for an exceptional bull run. I made 2 dedicated videos on both asset classes. Click down below on my channel description and watch those 2 videos if you haven't done so. Here a little bit more technical and zoomed in, but it's illustrating the same point. We are bound to go for really, really nice times in both assets, Bitcoin and gold. So my portfolio, crisis-proof portfolio, this is one option you can take. I'm still largely in gold and Bitcoin. I do have a little bit of stocks, mostly diversified things, and all around the world, emerging markets, India and Africa. I made a video on this as well. And I want to have some cash because with a banking crisis, stock prices, equity prices will decrease, and you can scoop up some great deals. This would be another portfolio that you could use. Very well diversified portfolio, some Bitcoin, some gold, some S&P 500, emerging markets, commodity, MSCI World, and of course some cash. So with that said, I hope I could illustrate a little bit on why all of this is happening. The next week or so is going to be super important to watch. We saw the ex-CEO of Coinbase making $1 million bet that Bitcoin will hit 1 million within the next 90 days. There is a Twitter space where he talks extensively on the reasoning why, and Bitcoin is practically the only asset you can hold that has no counterparty risk. Of course, you can buy physical gold, but Bitcoin is way faster and more agile and has just better attributes than gold. And if there is an unwind, if there is really a legit banking crisis, it could completely be legit that Bitcoin is gonna go absolute haywire. Maybe not 1 million, but you want to be allocated before that. So I really hope you have your allocation in Bitcoin, and please keep it in cold storage. Don't hold it with an exchange. Take custody, own your own keys. So with that said, subscribe to the channel, share that video with family and friends, like the video below, join us on Telegram for the discussion, and lots of love. I see you next time.